Good day. Today we're going to talk about Chapter 13, Corporate Financing Decisions in Efficient Capital Markets. The key concepts here to understand the importance of efficiency, to be able to define the forms of efficiency. We'll talk about 3 different forms of efficient markets. To talk about the empirical tests of market efficiency, not in detail but kind of in generalities. We're going to understand the implications of efficiency for corporate finance managers. Chapter is outlined as if you have a book you know. Okay, can financial decisions create value? In earlier parts of the book we've talked about net present value criteria and how we use that to make investment decisions. So in the next 4 chapters we're going to talk about financing decisions. In particular, how do we decide how much debt and equity, what's the mix of debt and equity we should have? When should we sell debt and equity, and when should we in fact pay dividends? We can use net present value to evaluate financing decisions. So creating value through financing, can we do it? Can we perhaps fool investors? Well, empirical evidence suggests that it's hard to fool investors consistently. Could we reduce costs or increase subsidies? Perhaps. Certain forms of financing, in particular debt financing, have tax advantages or can carry other subsidies. And what about just the idea of creating a novel claim on our assets, a new type of security, something that has not previously existed, that perhaps there's a clientele for? That might create some value, in the short run at least, until everyone else decides to copy us. Well, let's talk about efficient markets. An efficient market is one in which stock prices quickly and fully reflect available information. And I might add, accurately as well. So there is in finance something called an efficient market hypothesis, and it argues basically that markets are efficient. Excuse me. And the implications are these. Since information is reflected in security prices quickly, knowing information when it's released doesn't necessarily do you any good. In fact, some studies that have looked at microstructure in finance, just as an aside, have shown that within a second, or even fractions of a second of information being released, it's already being incorporated into stock prices. The other implication that firms should expect to receive a fair value for securities they sell. Firms can't necessarily profit from fooling investors in an efficient market. Well, what are the foundations of market efficiency? The first is that we assume investors are rational, we assume that events are independent, and we assume arbitrage. Arbitrage would be the trading away of inefficiencies. So let's take a look at a piece of news. We've lined days up so that time 0 here is the day of a news announcement. -10 would be 10 days before, +10 would be 10 days after, and so on. And here's some good news. Now, if the market is efficient, it should react quickly to the news, it should act appropriately, and that should be the end of it. One possibility, however, is that the market overreacts. Too many people try to get into a good thing all at once, and the market price perhaps goes too high, and then it works its way back down. If that is the case, if the market does overreact to good news, then we could, upon the announcement of the news, sell the stock and buy it back as the stock comes back down and retraces its path. On the other hand, if the market reacts slowly to good news, then we would buy the stock immediately and make a nice tidy profit over the next 10 or 20 or 30 days. Now, the same thing holds true with bad news. The market could overreact, in which case we might want to buy the stock upon the release of the bad news and then sell it back after maybe 10 or 20 days. Or the market might react slowly, in which case we would have time to sell the stock short and then cover our short position in a couple of weeks. What are the types of market efficiency? The first is weak form. Weak form says that market prices, that security prices correctly reflect all historical information. The second is semi-strong form, and it says security prices reflect publicly available information. And the strong form, which says security prices reflect all information, both public and private. Weak form market efficiency, that security prices reflect historical price and volume information. If that is true, then that would imply that technical analysis is of no value. And of course, as you can imagine, there's an army of technical analysts on Wall Street who would like to dispute the claim that markets are weak form efficient. But if they are, since stock prices only respond to new information, which by definition arrives in an unpredictable random way, then stock prices would follow a random walk, and knowing past behavior would not be helpful in predicting future behavior. Okay, take a look at, here's a pattern, a well-established pattern. You might think of something called channelingmarkets.com, which advertises that they can tell you when to sell and when to buy. You buy the same stock over and over and you make a return. You buy low and sell high. Well, what's the problem with this? If it were actually possible to trade on this kind of information, then everyone would realize it, everyone would do it, and because so many people would be selling at the same time and even anticipating the sale, the trend would soon be sold away, basically driven away by trading. Now, semi-strong form market efficiency says that security prices reflect all publicly available information. And by publicly available information, we would include historical price and volume, of course. So we're going to, if we're saying markets are semi-strong form efficient, we're also, by implication, saying that they're weak form efficient. It would also include published accounting statements, information found in annual reports, and even the reports of stock market analysts and others. And then finally, strong form market efficiency says that security prices reflect all information, not just historical information, not just current information, but even private information, even information that's held closely by managers and insiders. Strong form efficiency would incorporate weak and semi-strong forms, and it would say that anything, absolutely anything pertinent to the stock and known by at least one investor, even the CEO, is already incorporated into the securities price. Now, just as an aside, most people in academics buy into the notion of weak form and semi-strong form, but almost no one, and I mean almost no one, advocates strong form market efficiency. Market efficiency of the various forms are related to information sets. Weak form implies that we know the information set of past prices. Semi-strong form says not only do we know past prices, but we know all publicly available information. And strong form says not only do we know past prices and publicly available information, we know all relevant information, and it's all incorporated in the stock price. Well, what does the efficient market hypothesis say, and what does it not say? Well, some people have argued that since markets are efficient, investors can just throw darts at a Wall Street Journal or something, and whatever the dart lights on, that's what we'll buy. That's not quite true. Market efficiency does allow for variations in risk in securities. We've already talked about the capital asset pricing model in beta. But what market efficiency does say is that if you took, say, 10 different stocks in a widely diversified portfolio that had a beta of 2, it wouldn't matter which 10 you took as long as you want a beta of 2. Prices are random and uncaused. Well, the efficient market hypothesis does say that prices reflect information, and that since information arrives randomly, it can't be predicted, and therefore prices are random, but it does not say that they're uncaused. Stock prices are caused by information, but we just can't predict what it'll be and when it will arrive. Well, what's the evidence? The record of efficient market hypothesis has been tested extensively, and there is a large body of evidence supporting efficient markets. The studies of efficient markets generally fall into 3 broad categories. First is the question, are changes in stock prices random, or are there profitable trading rules? In other words, we can test technical trading, for instance, head and shoulders patterns, or double bottom, or double top, or whatever. And then the second is event studies, which look at particular events and ask, does the market react quickly and accurately to new information? And finally, there's the record of professionally managed investment firms. Well, are changes in stock prices random? Can we really tell? Psychologists and statisticians have argued that people tend to see what they want to see. And if you're faced with pure randomness and you want to see a pattern, you probably will. And so it's just a matter of degree. Let's take a look at this. Here's a randomly generated pattern. These are randomly produced numbers. And I think most people, many people would look at this, especially if it were a stock price, and say, wow, I see a pattern. Stock goes up, then it goes down, then it goes up, then it goes down. I can trade on this. Fact is, you can't trade on that. It's just a random walk. Well, what about event studies? Event studies are usually look at an event and take a number of different securities that experience the same event and line them up on a day called day zero, event day. And recall that efficient market hypothesis states that prices should reflect publicly available information. So the test to do an event study, we examine prices and returns over time, and especially in the immediate vicinity of the arrival of new information. The test is for evidence of underreaction or overreaction, early reaction or delayed reaction around the event. The first thing we do in an event study is we adjust returns. We take out the component of returns that we think we ought to expect based on the market. And then we look at what's left over, the remainder, and that's the abnormal component, and then we ask ourselves, is there a significant abnormal component associated with this event? Now, we're not going to be able to completely understand event studies here because there have been many papers written on it, Brown and Warner and many others, and this has been a subject of extensive study. But we look at the abnormal return on a given stock for a particular day. We calculate by subtracting the market return from the stock return. That would be one way of predicting the abnormal return, like this, or we can use what's called the market model approach, where we use the alpha and the beta of a stock from a regression line, and we say, look, based on the relation between the stock and the market, alpha plus beta times RM tells us what we ought to expect. We subtract that from the observed return, and what we have left is an abnormal return. Here's an event study. This is actually a study of companies announcing dividend emissions. Now, generally, I think you would agree that a dividend emission is bad news. So this would be an efficient market study of bad news. And day zero is the day that the actual news arrives. So we start looking at abnormal returns 8 days before, 7 days before, 6 days before, 5 days, 4 days, 3 days. Remember, these are averages of a number of different companies that have experienced this event. 2 days. Now, clearly a day before we began to see some significant decline. So investors are either the news has leaked out, either there is some kind of information out there that shouldn't be, or investors are just really smart and have anticipated that this bad news is coming. Here's the day of the announcement. We have a negative 5% abnormal return. And then after that, we don't see any significant over or under reaction. The stock price sort of declines and wanders around, but doesn't really seem to go anywhere after the event. So that would be a particular type of event study. Well, event study results. Event studies have been done on almost anything you can imagine. Dividend increases and decreases, earnings announcements, mergers, capital spending, new issues of stock, adoptions of poison pills, all kinds of things. And generally, these studies support the view that the market is semi-strong form efficient. Studies suggest markets may even have some foresight. In other words, either news leaks out or investors are pretty darn shrewd at figuring out what's going to happen when these public announcements are going to occur and what they're going to tell us. Now, what about the record? This is the second item, the record of mutual funds. If the market is semi-strong form efficient, then You shouldn't be able to use publicly available information to outperform a simple buy and hold strategy, and that means that professional mutual fund managers should on average do no better than you or I would. So we can test efficiency by comparing the performance of these professional managers against just a simple market index, an unmanaged portfolio, if you will. Here's the evidence. This is from Pastor and Stambach in 2002 in the Journal of Financial Economics called Mutual Fund Performance and Seemingly Unrelated Assets. Here we have mutual funds divided into categories. First is all funds, then small company growth, other aggressive growth, growth, income, growth and income, etc. Now, how do the professional managers in each of these categories do compared to, remember, compared to an unmanaged fund? Well, all funds did worse. So if you just held an unmanaged portfolio, you did better than the total of all managers. Small company growth funds did quite poorly. Aggressive growth funds did underperformed. Growth underperformed. Income underperformed. Growth and income, maximum capital gains, and sector funds all underperformed. So what this tells you is that by the time you get the professional manager and take out their management fees, they really can't perform any better than just, on average at least, any better than a simple unmanaged fund of the same type. Well, what about the strong form of efficient market hypothesis? One group of studies has looked at market efficiency when insiders trade. And a number of studies have supported the view that inside trading is abnormally profitable, which would tend to rule out strong form efficient market hypothesis. Okay, now there are some challenges to market efficiency. And the first is the behavioral challenge. So there's a whole discipline of finance called behavioral finance. And behavioral finance questions market efficiency based on rationality. And remember, one of the underlying tenets of market efficiency is that investors are rational, and psychologists and others argue that people are not always rational. Many investors fail to diversify. They trade too much. They try to maximize taxes and by selling winners and holding losers, even though that doesn't necessarily make economic sense. So people do a lot of irrational things. Independent deviations from rationality, psychologists argue that people deviate in predictable ways. Two things people do, representativeness and conservatism. Representativeness says, well, we take a few things and we immediately jump to the conclusion that those few things are representative of the whole population. So we draw conclusions from too little data, and that leads us to create bubbles in security prices. The other is conservatism. And that says that people are just too darn slow in adjusting their beliefs to new information. So along comes some new information and investors just don't react to it sufficiently. Now, arbitrage, the challenge. Suppose that your superior rational analysis shows that company ABC is overpriced. Well, if you're logical and rational and you have performed a proper analysis and the stock is overpriced, then perhaps you should sell it short. Arbitrage would suggest that. But then after the rest of investors come to their senses, you'll buy the company back and you'll make money because you were smart enough to sell high and buy low. So what's wrong with that? Well, what if the rest of the investment community doesn't come to their senses? What if it takes them 5 years to come to their senses? You can't hold a short position that long. And so that kind of arbitrage can become very risky, and the result is that perhaps, remember, one of the other underlying tenets of efficient markets, not only were investors rational, but there was arbitrage. That arbitrage may not exist. Now, what about empirical challenges? There have been empirical studies that have challenged whether markets are efficient. First of all, as we just kind of went over, the limits to arbitrage. Namely, markets can stay irrational longer than you can stay insolvent. You may not be able to wait 5 years in a short position waiting for the market to come to its senses. And here's another thing that seems to defy market efficiency. Earning surprises. there is evidence, empirical evidence from event studies and similar things, that stock prices adjust slowly to earnings announcements, perhaps because of conservatism. And then there's this size effect, which says, well, look, if you take firms and you divide them up into small and medium and large cap, and you adjust for the risk involved, for some reason, even after you adjust for the risk, small cap stocks seem to outperform large cap stocks. And that doesn't seem consistent with efficient markets. And then there's this value versus growth idea. There have been a number of studies that have shown that value stocks tend to outperform growth stocks. Now, a value stock would be a stock with a high PE ratio, a low PE ratio or a low price to book ratio, or if you flip it upside down, high book to price ratio or high earnings to price ratio. Those value stocks tend to outperform growth stocks. Empirical challenges, well, think about the crash of 1987. In one single day, the stock market dropped between 20 and 25% on a Monday following a weekend. Researchers have gone back and scoured the media looking for an explanation, looking for some news, looking for a surprise, and guess what? Nobody finds anything on Monday that wasn't known on Friday. So that it's very hard to explain why the market drops 20 to 25% in a vacuum, without news. And then bubbles. There's an interesting book that talks about, it's called A Random Walk Down Wall Street. It's by Burton Malkiel, and talks about bubbles. In fact, traces the history of bubbles going clear back to the tulip bulb craze and the South Sea bubble and going all the way through the modern markets. Bubbles just consistently keep popping up. The latest was probably the dot-com bubble or the real estate bubble that we just had. Well, reviewing the difference, where do you stand? Financial economists, those in academia, have sorted themselves into three camps. Those who believe markets are efficient, those who believe perhaps in behavioral finance, conservatism and representativeness, and then kind of the agnostics, those who admit they don't know, they have no opinion. And actually I'd put a fourth group, and that is those who believe markets are inefficient, because there is a significant group of people who believe markets are inefficient. This is an understatement of the year, perhaps the most contentious area in the field of finance. Well, what are the implications of corporate finance, implications of efficient markets for corporate finance? Well, because information is reflected in security prices quickly, investors should expect to earn a normal rate of return, but they should not be expected to outperform a buy and hold strategy. They shouldn't expect to get a return that exceeds what the beta would suggest the expected return of the stock will provide. And firms should expect to receive the fair value of the securities they sell. So on the buy side, investors shouldn't expect to receive an unfair advantage, and on the sell side, firms shouldn't expect to receive an unfair price. The efficient market hypothesis has three implications for corporate finance. The first is that a company's stock price can be affected by cannot be affected by a change in accounting. So if you think, for instance, that changing from LIFO to FIFO, or changing your revenue recognition method, or using a different method of depreciation or some other thing is going to change the value of your stock, it probably won't. Second, financial managers can't time issues of stock and bonds using publicly available information, which would suggest that any time is as good a time as any other time to sell stock, and I don't think most people buy into that. The third notion is that a firm can sell as many shares of a stock or bond as it desires without depressing prices, and I really question that too. So there's conflicting empirical evidence on all three of those points. Well, why doesn't everyone believe in this theory? First of all, clearly there are optical illusions, mirages, and apparent patterns in charts of stock prices, and people want to believe that, and so they do. Maybe the truth is less interesting. I mean, who really wants to believe that you can trust stock prices, so why bother spending a lot of time? That isn't very interesting. And then there is that empirical evidence against market efficiency. I talked about the size effect, but seasonality is another one, and value versus growth stocks is another one. And the tests of market efficiency are weak, and regardless of how well constructed the test is, there always seems to be someone who can come up with something that was left out or something that is flawed in the study. All right, that concludes our discussion. Let's have a quick quiz, kind of mentally go through this for yourself. Can you define capital market efficiency, and how would you define it? I would define capital market efficiency as the tendency of stocks to quickly and accurately incorporate new information into prices. What are the three forms of efficiency? Well, I hope you said weak form, semi-strong form, and strong form efficiency. What does the evidence say regarding the efficiency of capital markets? Well, we've talked about a lot of evidence. We talked about event studies. We talked about the performance of mutual fund managers. We talked about psychology. We talked about arbitrage. We talked about empirical evidence contradicting efficient markets. We talked about a lot of things. What are the implications for corporate finance managers? And we talked about 3 implications at least. And that concludes our discussion.